Welcome back to our intermediate financial accounting class. Over the last few segments, we've been focused on revenue recognition, what it is, why it's important, how FASB's changed it recently, and how to use those new steps, 5 key steps that FASB has listed as the way to recognize revenue in these new rules. So we've done several examples already, and we just want to continue on with some more examples of revenue recognition. Now that we've looked at basics, and we've looked at multiple deliverables, the next fun piece is early recognition. And we've done some of that with our construction company earlier, but we really want to focus on how to do that in a more maybe involved or challenging, or perhaps we'll just call it a richer situation. So let's take a look first of all at a review of why this is important and why we get to do this, and then we'll take a look at some steps for the different methods out there for recognizing the revenue before delivery. First off, remember that FASB's preference is that we wait until revenue is completely earned. That's what they want. But they recognize that that's not feasible for all businesses. So they came up with 3 requirements that we've already talked about that allow us to recognize revenue as we complete the process and not waiting until we're all the way done. So here are the rules. If the customer receives the benefits as they occur, so if I do some CPE training and provide it in different locations, then because my clients can start using the information at those different locations as I go, I could use this early revenue recognition method. Second, does what I'm providing simply enhance a product that they're already using? The example that we gave earlier was if I am upgrading or improving a school or a hospital and they can keep using the parts of the hospital that are already open, and as I finish each piece of the hospital, I update radiology and they can start using radiology while I move on and improve the operating rooms, then I can recognize the revenue as I go because my client can use the different pieces of the project as I move forward. The last option is if I'm creating an asset that's unique, that only can be sold to my buyer, I can recognize the revenue early, assuming that they have to pay me for whatever piece I get done. So if any of those 3 rules fall into place, then I have an option of recognizing the revenue early. I don't have to. Please remember, you can always wait till the end if you prefer, because that's FASB's preference. But if you decide you want to recognize the revenue early during the process of completing the obligation, then you have to meet one of those 3 special situations or circumstances. If I meet one of those 3 requirements, then the idea is to recognize revenue as I satisfy the obligation. So we want to recognize it based on our progress towards satisfaction. The best way to do that is to use the cost. How much have I spent out of what I think I'll spend? If I can't do it that way because I don't have good cost estimates, then I sometimes have to tweak my method. But I have to be able to measure my progress somehow. So if I can't do it by cost, because I don't know how much the last stages are going to cost, but I can see I've completed 10 rooms out of 20, you're about half done. FASB's preference is to use cost, but there are other options. I just have to be able to come up with some logical way of measuring how far along I am in the process. Now, if I can't measure my progress, but I think I can be reimbursed for my work, so I'm not 100% sure how much it's going to cost me or how many hours it's going to take, but I know whatever I've gotten done they're going to pay me for, then I can at least recognize some revenue, just enough to match up with whatever I've spent so far. If I can't even do that, if I can't measure my progress and I'm not sure the compensation will cover my costs, then I have to wait till I'm 100% done. So if I can come up with an estimate, I can recognize revenue and show a profit as I go. If I can't come up with good estimates, then I can at least cover my costs. If I can't be sure I'll at least cover my costs and I don't have good estimates, then even if I meet one of the requirements, I have to wait until the end to recognize the revenue. Let's start out with the first method, assuming that I've got good estimates and I know I'm going to get paid and I meet one of the requirements. I get to use what we call the percentage of completion method. And there are 5 steps to this method. First off, I recognize all of the costs of this contract in a special contract asset account. Second, I recognize any payments that my client has made as either a contract liability or as a reduction to accounts receivable if I've recognized some of the revenue in the past. Third, I determine the percent of work completed by the end of this particular period by adding up everything I've spent so far, plus what I think I'm going to spend to get a total cost, and I take the total I've spent so far divided by that total estimated cost, and that gives me my percent done. I figure out how much revenue I can recognize this period by taking the total revenue times the percentage completed to get the total I can recognize, and then subtract what I already have recognized. That's the amount I can recognize now. And finally, I do my journal entry. I recognize my revenue, and of course, I also recognize my costs. Let's take a look at an example of this process. This is Colfax Construction Company, CCC. They've contracted with the state of Washington to build a highway, 100 miles of highway through a rugged mountain area. Going to take them 5 years to do it. They'll earn $50 million. That's the revenue coming in. They can bill the state of Washington based on construction they've completed up to any given day, and they expect to fulfill the whole contract, and they can estimate what their future costs are because they've done this quite often. If the state of Washington cancels the contract, CCC will still get paid based on what they have completed up to cancellation. We want to do all the necessary journal entries for the 5 years. So this is your chance to do a million different journal entries. Let's start out with our basic revenue recognition steps, and we'll add in the before delivery elements as we go. So first off, do we have a contract? Yes, we do. We are contracting to do something specific for the state of Washington, build this road. They're going to pay us a specific amount. We know how we're going to get paid. We think we're going to get paid because whatever we get done, they have to pay us for. So we've met the basic requirements for a GAAP contract. Step 2, identify the performance obligations. Well, there's only one this time, build a highway. That's it. There's nothing else in there. There's no special elements to this contract. I just build the road and I get paid for whatever I make, either finishing it or canceling early. That's what I get. So that's all of my performance obligations, just the one. Step 3, what's my transaction price? Well, the contract price is $50 million. I have no reason to believe that they'll pay me less than that. So I'm going to assume it's the $50 million. If I had history with the state of Washington saying, oh, they usually contract out these projects and then they cancel halfway through, then I'd have to cut it in half. But I don't know anything like that. And I don't have anything in there about penalties or fees that I might pay or they might pay. So really that's my best guess. So we'll go with the $50 million for step 3. Step 4, allocate the price to obligations. I don't even need a 10 key for this one. One obligation, one transaction price, $50 million. That's it. Now we're down to step 5, recognizing the revenue as the obligations are performed. And the question is, do I have to wait till I'm done with the highway, or can I recognize the revenue as I go? The answer is I can recognize it as I go. Why? Well, it's not because they can use the asset as I make it. It's a highway in the middle of nowhere, right? Rugged terrain, it tells me. So if I make half of this, they can't start using it because a highway to nowhere is worthless. So it's not because of that first requirement. The second requirement is, does it enhance something that the state of Washington already owns? Am I just building onto their roadway? The answer is no. This roadway is separate. It's unique because it's going to a separate place. That's why they need it. It's not that I'm enhancing roads or building roads that people can still use, so it's not the second one. However, it does meet the third obligation because, number 1, I can't make this for anybody else. State of Washington is the only group that could buy this. So practically, it's for them and only for them and useless to anybody else. That meets the first part of that requirement. Second, will I get paid for whatever I complete, even if they cancel the contract? The answer is yes. It tells us that in that third bullet point. So this obligation meets one of the 3 requirements for early recognition. The next thing I need to know is, can I estimate both the amount I'll get and the amount I'll spend? And the answer is yes. We're told here in the second bullet that we can estimate our future costs because we've done this before. We're pretty good at it as a construction company. So I can estimate where I'm at. And because I can estimate where I'm at and how much they're going to pay, I can figure out how much revenue should be allocated each period. So I'm in good shape. I can use the best option out there and actually show a profit, assuming things go to plan, each period as I move forward. So let's take a look then at year number 1 under the percentage of completion method. So this is year 1. And step number 1 is to record my cost. Now remember, we're making one journal entry in this step that actually summarizes a million different entries that would occur all year long. Every time I cut a check, every time I paid an employee, every time I recognized payroll, every time I used up inventory or supplies, I would do a journal entry for one small portion of the total. But we don't have time to make that many journal entries, as fun as it would be. So we're going to keep it simple and just do one entry that summarizes everything for year one. So let's go back to our table. And in year one, we spent $3.4 million. Contract asset. And I'm just going to use cash, although it could be wages payable and inventory and supplies and whatever. I'm just going to use cash for simplicity. 3.4. This is to recognize my costs. Step number 2 is to record any payments. Let's take a look here. It says that they collected $1 million during the year. Cash came in for $1 million. And in this case, I haven't recorded any accounts receivable yet, so it would have to go to my contract liability. Now let's not abbreviate quite that much, that's better. This is to record payments. Step 3 is to figure out the percentage that I have completed. And to do that, I take the total spent by the estimated total cost. We know the total spent, that's from step 1. So far I've spent $3.4 million. And I'm going to divide by the total cost. So let's go back. We've spent 3.4 so far. We think we're going to spend another 30 million.6. So 3.4 million plus 30.6 million. 3.4 million divided by 34 million. So I'm about 10% done with this project. Step 4, we're going to use that percentage to figure out how much revenue I can recognize now. So to calculate the current revenue. And to do that, I take my transaction price times the percent completed. That's really ugly. Sorry about that. That equals my revenue earned. So in this case, the transaction price was 50 million. Percentage completed, that's that 10% we just calculated. So I've earned $5 million so far, or the company has. I next take my revenue earned minus revenue from previous periods. And that gives me my current revenue. So revenue earned, that's this number. I'll just bring it down. This is the first year of the project, so I've recognized nothing so far. So this year, I can recognize the $5 million. And that means I can do a journal entry. Yes, the best part. And that brings us to step 5, which is to record revenue. I'm going to record sales revenue, $5 million. Now I need debits. Well, the first thing I would get rid of is any unearned revenue, if I can. So I would have recorded that in step 2. Let's take a look. Step 2, there's my contract liability for $1 million. They gave me money. I haven't earned it, but I have earned $5 million now. So I can get rid of that contract liability. Contract liability. I've earned everything they've paid me so far. And more. So I'm going to record an account receivable for the rest, because they now owe me that $4 million. And that takes care of my revenue. The last part, though, is I can't recognize the revenue without the cost. So cost of sales, or you can use cost of goods sold if you want to. This is going to be equal to the amount from step 1, which is 3.4 million. And we'll take that out of our contract asset. And this is to recognize revenue and cost of the project. Last thing we need to do, because this is a continuing project, we need to make sure our T accounts are up to date. I have 2 of them I have to worry about, because my contract asset has gone to 0, started in step 1 at 3.4 debit, credited it out, 3.4, it's gone to 0. But I do have a couple that I do need to keep track of. And I'm going to have to erase some of this, sorry. First is my accounts receivable. It starts at 0, but I've just put in 4 million, so I'll bring that down here. So I'm going to end this first year with them owing me $4 million. My contract liability started with $1 million, but I wiped it out. So my contract liability, like my contract asset, has gone to 0. The only thing then that I have a balance with moving forward is my accounts receivable. And I'll need to know that as I move forward in the process. So we'll keep track of those T accounts as we go. Now that gets us through our first year's worth of transactions for this multiple year project. When we come back, we'll look at years 2 and 3. So the fun continues. We'll see you then. Thanks.